Welcome back to another episode of Multifamily AP 360. And today's our guest is Whitney from Lightbridge Capital. So welcome, Whitney.
Honored to be here, Raymond.
Awesome. Thank you very much. And a little bit about Whitney. Whitney Sewell is your trusted guide to prosperity and entrepreneurship purpose. A Kentucky native and Army National Guard veteran, his journey is marked by resilience and a commitment to making a difference. In 2009, realizing that law enforcement wouldn't provide the financial freedom he desired, Whitney and his wife, Chelsea, turned to real estate investment. He founded Lightbridge Capital, LLC in 2017, a venture that not only offers investors exceptional returns, but also contributes 50% of Whitney's personal profits to support adoption. Whitney's influence extends behind business. As the host of the Real Estate Syndication Show, he shares wisdom from industry experts, empowering past investors. He and his wife are the founders of the Omna Foundation, dedicated to helping orphans and their adoptive families. With a portfolio of 1,500 units valued at approximately $450 million, Whitney and his business partner, Sam, have led Lightbridge Capital's remarkable growth. So with that, Whitney, you want to add anything to your background?
You pretty much got it, but we know background in military, a year in Iraq, come home and became a police officer for a few years. And it was really real estate at that time that I was hoping would supplement my income of $28,000 a year. And I was newly married and found out it was going to be hard to support a family on $28,000 a year. I learned about rental real estate, and then we bought a couple triplexes, and hoping that, man, even $200 extra a month would have made a big difference in our income at that time. And we learned a lot the hard way through those. Even those two just made a lot of mistakes, and I gained a lot of brain damage. But shortly after, I became a federal agent. That moved us to Virginia, where we live now. And years later, I was training horses professionally as well. But it was more than two full-time jobs, federal agent in the horse training business. And so we literally sold the farm so we could start Lightbridge Capital. I knew commercial real estate could build wealth and would allow us to build wealth, but also to be able to give more than we've ever been able to give before. And so we just said, you know what, we're going to completely focus on that. And so we literally sold the farm so we could do it. But that really helped us to commit in a big way, just burn the bridge. And it did for our whole family. And our family's been shaped by adoption, as you mentioned, but we now have 5 children through adoption. We had a call actually just a week ago Saturday about a little girl that needed a home, or a baby girl that was supposed to be born in December, and she was born the next Tuesday. And anyway, we have her home now. So the Lord's just shaped our family through adoption, and now we want to help other families as well that are struggling to afford to adopt, because it can be $50,000 to $75,000 or more, unfortunately, to bring your children home or your child home through adoption. And so most families can't afford to do that, or struggling to. And so that's our big mission, or one of our big missions behind Lightbridge Capital, is helping these families through the Omna Foundation to be able to bring their children home.
Absolutely awesome, and appreciate that one. And there's a quote, right? Your quote: when you invest with Whitney, you're not only growing your wealth, you're becoming part of a movement that changes lives, one investor, one family, and one child at a time. So would you elaborate, share your experience around that?
Yeah, we never imagined what the Lord would do through that. We've partnered with just over 50 families now through Omna. And so everybody talks about having a why, right? Know what your why is, know what your mission is, but nobody really takes that very serious. And I feel like, or most people don't, and I didn't either. And so I started going to conferences, and people would talk about their why and knowing what your why is. And that's really where I would exit. I would go to the back of the room and start networking and meeting people and thinking, man, okay, whatever. But what I've learned is that when my wife and I had a why, had a mission that's bigger than us, it really changed everything for us. Because selling the farm was very difficult. I'll never forget my wife and I pulling out of the driveway, and both of us just crying and thinking, have we made a mistake? Is this right? Everybody thought we were crazy. Our family, everybody thought, what in the world's going on? Why would you sell this house, the farm? But we had a mission that was bigger than that. And so that shaped that in a massive way. And so even a few years, or a while, renting a house and buying another little house in town before we could move back out to another farm, that was just a time of of really commitment for our whole family. But the mission really unified not only my wife and I, but my children as well. And so they, as a mission they could understand at their own level, all having their own story of adoption. And they could see, hey, we're doing this because we want to help other families to be able to bring their children home. And we'll have another farm someday. But right now, this is our focus in those times when it was really difficult. And so my my wife couldn't care less about real estate, but she really cares about our mission. Right. And so that unified us, even when I'm traveling every weekend or every week somewhere, or especially early on when you're spending so much time getting a business started, that mission really shaped everything.
Thank you for what you're doing, yeah, and impacting communities. So now, like we are in 2024 December, so now your portfolio is around 1,500 plus units, 450 million plus assets under management. So if you're looking back to your career, what are the most significant shifts you have seen in the apartment investing space? How exactly you adapted changes?
Yeah. This obviously the floating rate debt has been it's just such a pain, right, for so many operators over the last couple of years. And over the 2 years ago, I would say about 24 months ago, when really all that started settling in, I was pretty discouraged. And even for that next 6, 12 months after that, I just thought, what is going on? All this, it seems like other people are doing deals and we're not. And it seems just painfully slow, where we were doing, I don't know, about 4 deals a year on average, or 100 million or so, or a little more a year on average in acquisitions. And then all of a sudden it's nothing or one deal. And so I just thought, what are we doing wrong? And so I just think, even for my business partner, Sam and I, we were just, it was discouraging, right? Like, what's happening? And the debt's too expensive and we can't seem to afford to buy anything. And then even the next 12 months or so, I would say we went through a process of really gratefulness that we didn't buy more than we had. And we had a few projects with floating rate debt, which have not been amazing, but thankfully a couple of them have been in a larger fund as well. And so they've not really, it's not hurt the fund in a massive way, and they'll be refinanced in the very near future because of some other deals that are performing really well. But that has definitely shaped the way that we were, and we still will do value add, I'm sure, but we've been very focused on value add, older assets, say 70s, 80s vintage, something like that. And while we'll still probably do some of that, we've just changed our focus a little bit to newer assets, and some brand new, but not completely. And so there's some value add component, but just not the heavy lifts. And so it's just and another thing that shaped that is really investor sentiment. As we go through a business plan, a heavy value add business plan, especially over the last couple of years, or if you have to pause distributions or anything, investors get concerned. They see the deal in that initial email that goes out, and if it says a 25% IRR, well, they're like, oh my goodness, this is going to be amazing. But through the life of that deal, if it's a little like this, up and down, they get, oh my goodness, what's going on? And they get really concerned. And so I think early on, put enough weight on that, on the life cycle of what the investor goes through the life cycle of the deal, and really like ensuring the deal and what's going to happen in that deal really matches what the investors are wanting, in a way that, hey, more of them than not just want the passive income, right? Steady. They want steady passive income. Many of them are happy to have a larger hit at the end. And there's always, it's usually where the larger hit is. But I just mean many of them want just the steady check every month, when they don't want it to change. If it doesn't change, they don't ever look at your updates. But as soon as it changes, then they're really concerned. Even if it's just a little bit less, they're concerned. And so what I've found is, hey, if I, instead of that 25% IRR, if I'm even showing a 15% IRR, but they just feel like it's a very steady business plan, it's a newer asset, there's less deferred maintenance, it's better tenant class, all these things, there's still ways we can add value, but it's not us having to go in and vacate half the units or all those things, where the cash flow goes way down for a period of time. And so for us, we feel like long term, we're better off to buy somewhat newer assets. And so for our investors, it's just steady, right? They're getting that, whatever it is, that they can just every month, it's already a business plan that's operating. There's a lot less, if any, deferred maintenance. It's just a very different business than a 70s vintage deal, in a bad part of town, or with just a lot different work to be done, right? And so anyway, I hope that answers your question. But that's just a change that we've gone through, I think, even over the last couple of years, as we've struggled to even find deals, or to do any deals, or to buy anything. We just closed on a small project in Kansas City, Missouri. But even that, it was much smaller than we would normally buy, but it was really close to another portfolio that we already have there. And so it made sense for us to buy it. But But we have to get creative with some builders that we know or developers that we've created partnerships with, or it's something like that where it's okay, we can share all these resources with another portfolio that we have that's so close, right?
Yeah, absolutely. Thank you very much for sharing that. So bridge loans or short-term loans and also rate caps really impacted like last 2 years, right? So most of the investors impacted with that. And also like from your investment point of view, are you guys going with agency loans, and what kind of hold period you have on for these new projects? Or you plan to
Yeah.
hold it for 5 7 years?
So
Yeah.
we're very focused on agency debt, the long-term fixed rate debt. That's just almost, we're just not, not to say there's a space for bridge debt, right? But I think people are, I hope anyway, are going to be so much more calculated than they've ever been in the past, or they're going to make less assumptions than they've made in the past about what they think interest rates can go to. Or they're going to make sure that, hey, when this cap expires, they're going to make sure they have funds to buy a new cap, even if, or if it's going to cost a lot more than they expected, things like that. Because there's just so many really got caught, and us almost as well. It's so lots of learning lessons there. But all I'd say, long-term fixed rate debt is like I would prefer 7 to 10 years fixed rate, if at all possible.
Yeah. So with especially with new products or new projects, long-term agency might be good fit, right? So and from market point of view, are you guys planning to target Midwest markets or any other markets, and also are you planning to go after new projects? So what's your criteria?
Yeah, we have been very focused in the West and Midwest from the beginning. And really, I met my business partner, Sam, and he lived in Denver at the time. He already had deal flow in Colorado Springs. And so it just made sense for us to start there because it was a good market. It's had very steady growth for 100 years. It's not a Dallas Fort Worth, but it has had steady growth for a long time. And so we thought we're going to start there. And then we just grew from there. And he's originally from Boise. And so he really was in charge of acquisitions or broker relations then. And so we started gaining more deal flow in Boise as well. It was a really good time to buy there a few years ago, and it still is. But then we've started buying in Kansas City, Missouri as well. There's some other Midwestern markets that I think we're very interested in, but that's where we're very focused right now, especially in Boise and Kansas City. It's been really good for us though, where most of the competition is very focused in the South, Southeast, right? Texas, Florida, Carolinas, those areas. And those are great markets, no doubt about it. But it's just, I felt like a lot of our investors are come to us for diversification as well, to be in good markets in the West and Midwest also. So we didn't plan it that way, I don't think, in the very beginning, but it's starting that, but now we are planning it that way, or just to stay in that Midwest markets.
Yeah. So Midwest, the advantage with is like good cash from day one compared to Southeast markets. Yeah. So from operations point of view, so last 2 years are like rent growth is like many Southeast markets or some West markets are like flat, and expenses going up like from real estate taxes, insurances, right? So what exactly you guys are doing from operations point of view? Are you guys going with in-house property management or construction renovations? How exactly are you managing?
Yeah, so we have a long story with property management, but as I guess most operators do it sometimes or often. But when we first started, we were using a small group in the Springs, and ultimately, the more we learned, the more we pushed them. And we would start asking questions. What about this? Or I would learn something on the podcast, right? And from somebody, wait a minute, why aren't we doing that? And we would ask them, or are we doing this thing? And long story short, we kept pushing. They eventually fired us. But they were still operating like they were 20 years ago. They just had not improved their operations. It was still archaic in many ways, the way they were doing business. And so long story, it's been a blessing that happened, but it pushed us. We had almost no choice but to stand up our own management company really quickly. They gave us 30 days and eventually gave us 60 days, but we did. So we hired 50, 60 people in 60 days and managed our own properties for about a year. But when we started that process, we told ourselves, hey, about 10 months in, we're going to assess how we're doing, right? We're going to really compare to the market. We're going to go out and get some third party management quotes and see what they can manage our portfolio for and compare it to what we're doing. And ultimately, some of the really large firms that we already had a connection to, they could do it so much more efficient than we could. And so we had to make the decision to go back out to third party. And I know some people are so stuck on in-house management, and I know there's pros to doing that. I think in some senses, there's some cons as well that we learned. But in our case, we had a really good connection to a really large group and manages like 65 to 75,000 units. And we just could never be as efficient as they are. And they have just done an amazing job. And it's not an easy process finding that partner, though. It Yeah, it definitely was not easy to figure out who that was going to be, but I'm thankful that we went through the process even of doing our own management for a while, 'cause I think there's so many lessons learned, not only just if we ever had to do it again, but or decided to, but also when we're picking that third party partner. There's a lot more questions we know to ask now that we've somewhat been in those shoes to some degree. But all I'd say, we are back with a third party management company now who are just very institutional quality, right? Just very top notch. They can follow us to any market and grow with us really easily. They also agreed to take on all of our employees that wanted to stay, which was pretty incredible because I cared about all these people. I didn't want to just have to let 50 people go. And if we could keep from it, and they agreed to give them all a job that wanted to. And so that was, I loved that also. And, but anyway, all that to say, we're back with third party management and they're doing a great job now.
Awesome. Thank you. So what's your take on interest rates and new supply, high supply and demand side next to 12 to 18 months?
Yeah. One thing I do know is that nobody really knows what's gonna happen, right? But I do expect a potential drop, another drop here really soon, and I just think there's gonna be more deal flow because of that, and there's gonna be more transactions to be had. It's gonna loosen some things up that hasn't happened in a while. I'm questionable about next year. I am honestly, with Trump winning, love him or hate him, he's very business focused, and I just think it's spurred some energy in a lot of markets in a good way, and including real estate. And so I think it's very likely to be a positive environment to buy in over the next 12 months. I don't know after that. I don't even know for sure next year. None of us do. But what I do know is that if we stick to some basics like we have that have proven just over time, even through over the last 24 months, that's what killed many of these deals. The debt's too expensive, or we can't get long-term fixed rate debt, or the deal won't cash flow because the debt's so expensive. And so we're going to pass. And so just through some basics like that, does it make sense or not? Can it withstand through some simple stress testing as well? What's going to kill it? And that's what we want to know. And depending on what kills it or how that could happen, we're going to pass. And no matter if interest rates are up or down or whatever's happening, I feel like if we're buying deals that are cash flowing, long-term fixed rate debt, there's just a lot of risk that's already taken off the table.
Yeah, absolutely. Thank you. Thank you for sharing that. So would you share any of your best experience so far?
Best?
Yeah, best apartment investing experience.
Yeah, we just sold a community that we bought, or I tell you what, we've got a couple right now. We just sold one. I think we bought it for 26 or 7 million. And then 2.5 years later, we've sold it, or maybe 3 years, we've sold it for 39 million. So a big win for our investors. And then actually another one right now that's in that fund, we bought for 20 million 3 years ago, and we have a contract on it at 44 million. And so just very grateful for that. Some of those are our best wins so far, those two assets for sure. And both of them are newer assets, but very market specific. Like one of those is in Boise, and Boise has really grown over the last 2 to 3 years in a massive way. Through the COVID stuff, that a lot of people exited California and have come to those markets. But while those were really good because they're big wins for our investors, I do think some harder assets that for us have been probably better long term for us because it's taught us some lessons. And whether we didn't raise enough CapEx dollars in the beginning, we've had a couple of those from early on where it's, man, we get into the weeds and there's stuff happening. It's like, we could have used a couple hundred extra $1,000 to fix this from the beginning. There's just things like that it's just hard to know till you have experience in some of those areas. And those, I think the hard times are what makes the man. And sometimes it's the hard times what makes the business long term if you can survive.
Sure. Thank you. So any personal habits that are helping you to be successful?
For us, I think a personal habit. I mean, I love morning routines. I love having a very structured morning. I love like let's say 5:15. I'm up, and my wife and I. It's been a time even when the business was early on and getting started, and it was really more of a difficult time for us as a family. That time was crucial for my wife and I to be able to connect and talk about the week and talk about our kids and read together, pray together, all those things. Because I may not see her again the rest of the day, or I'd be gone during as a federal agent, and I'd come back, and I'd be working for the real estate business till really late most nights, and on the weekends or traveling. So that morning routine became a very crucial time, but it also became a time for me of education. And so of reading and like consistently reading something that encouraged me, it helped me to just improve personally. And so I had to be willing to be committed to that. I had to be willing to change, I think, as well. I had to be willing to take these things and figure out, okay, how to apply them. And one of the first books that I was really committed to many years ago was The Miracle Morning by Hal Elrod. And I don't follow all those things. However, it did make me really think about, what am I doing with all this time? Like, why aren't I being more intentional? Get your butt out of bed and let's be intentional with this time. And what I find is it is so helpful for me to have that written out. Like from 5 to 5:20, this is what's happening. From 5:20 to 6, I'm exercising, or from this time I'm reading, whatever. And then I just mentally, I know, hey, oh, I've got to get out of bed, or I'm starting behind already, or I've got to have this done by this time. And so that's been really instrumental, I think, in my personal growth, but also for business growth. But habits, I think, too, is just caring about people and putting your team members first in every conversation, and even networking and asking, hey, how are you doing? That's gone a long way for me, but just really caring about people, honestly, has been something the Lord's helped me with. But that has, yeah, that's gone a long ways. Just being a good habit.
Oh, awesome. Thank you. So how can listeners can connect with you, Whitney?
Remember, they can go to whitneysewell.com, or you can go to lifebridgecapital.com, of course. If you go to whitneysewell.com, you'll learn a lot more about me and the foundation and some of the real estate business stuff, but it's more of a personal brand that I'm coaching more, wanting and helping more men now just to lead well in their homes. And so there's a free little course you can go through that helps people build a family mission statement. Like, we're so focused on our business mission statement and how important it is, all those things, but we're not as intentional, unfortunately, with the ones we say that we're doing all this for, right? And I want to help men to be very intentional with their families and leading well as a husband and father. And so I encourage you to go to whitneysewell.com.
Awesome. Thank you very much. Thank you. Thank you, Whitney.